Let's go on to Eric Kalis for story number 5. Eric, this story is coming out of CNBC. I'll read you the headline. And then CNBC does a thing where they give you like 3 key points. I'm going to read you the 3 key points, and then I'll just ask you to elaborate. So, headline, Dimon, meaning Jamie Dimon from JP Morgan. Dimon warns that the Fed could still raise interest rates sharply from here. And here are the 3 key points come from CNBC. Point number 1, JP Morgan Chase CEO Jamie Dimon is warning that interest rates could go up quite a bit further as policymakers face the prospects of elevated inflation and slow growth. Point number 2, and this is a quote. This is coming out of the Times of India. JP Dimon was quoted in the Times of India. Here's the quote. I'm not sure if the world is prepared for 7% interest rates. And he's referring to federal funds rate, which is basically the bare bone wholesale rate. And then other interest rates that are out there, they typically trade off of that and they put spreads on them. And point number 3, Eric, the comments come less than a week after Fed officials indicated that they could approve another quarter point increase before beginning to cut a few times in 2024. What say you, Mr. Kalis? Are we going to see a federal funds rate at 7%? And is the world economy, and especially the Miami economy, equipped and ready for what Mr. Dimon says is coming? And I will mention to you, Jamie Dimon's got a suggestion or a nickname. They call him Hurricane Jamie, Hurricane Dimon, because he made a comment a year ago or so talking about how a hurricane was approaching.
He definitely ears on the side of bearish. And I went back and saw he had very similar comments in May of this year too. So this is not the first time that he has beaten this drum. The first thing you got to ask yourself is, what does he know that we don't know? He is the CEO of the largest bank in the U.S., I believe. And so he's privy to information we don't have. But his premise is largely based on the fiscal spending. He also cited the global energy transition, but fiscal spending. So apparently, and this is not a stat directly from me, obviously, but apparently we have, since the Obama administration, spent $15 billion more than we've taken in. So that metric in and of itself is, I think, driving a lot of his bearishness. That being said, the Fed last week insinuated that maybe one more quarter point increase, then we start to see cuts in 2024, at least a few cuts. So it's hard to fathom how we get to a 7% benchmark rate if the Fed is indicating that it's moving in another direction. So you wonder what Jamie Dimon knows that we don't. If I was going to try to find a sliver of positive spin, especially in our local market, as John has pointed out, has been essentially frozen for over a year, especially on the resi side, maybe this motivates some of those would-be buyers who have been waiting for interest rates to drop and now realize not only are prices not going to drop, but interest rates may be going up, and they may be going up to 9, even 10%, which, by the way, someone like a Mike Pappas will tell you that I think he said to me 35 of the last 50 years, we've had interest rates, I think, above 6%. So we're really, the interest rates we're experiencing now are in line with historical norms in the last decade. Was an anomaly. But maybe some people on the fence might move forward with purchasing now out of fear that what Jamie Dimon is saying will come true, and ascribe to the theory, buy now, refi later, which us PR and marketing pros have been putting out that message to try to get people off the schneid here and to move forward with purchasing. But maybe it does get some people to move forward because, as I pointed out previously, the cost to build new here now is so much more expensive than even a couple years ago, that the new product that you're waiting for is going to cost so much more that it's going to offset whatever perceived incremental interest rate savings you're going to have by waiting. So there's going to be a behavioral, a visceral reaction to Jamie Dimon's comments one way or another.
John, I want to get your comments, but let me read you a quote out of the story. And I will preface it by saying there's been some stories talking about consumer credit card is spiking in the United States. We've also have auto loans. People are falling behind on their auto loans. But here's the quote, and I want you to comment on what Hurricane Jamie or Hurricane Dimon and his projections. Here's the quote. It comes from the story. It says, to emphasize the point Dimon's making, he referred to Warren Buffett's much cited quote, only when the tide goes out do you discover who's been swimming naked. True or false, John? Is Jamie Dimon, is he too bearish or is he not bearish enough?
he needs to protect his bank. So he needs to shore up his capital and make sure that he's going to weather any big spikes in interest rates. And quite frankly, the Fed has said rates are going to stay higher for longer. And that's been the mantra lately. And the real problem, I think, for Miami is commercial real estate, because a lot of developers and builders started their projects with construction loans that were very cheap. And a lot of them have loans that were taken out when rates were extremely favorable, and they paid up for properties because they could. And now 5 or 7 years later, they have to refinance at double the rates. Oh boy, there's going to be, I think Jamie Dimon is referring to the tide when the tide goes out. So their cost of capital is basically going to more than double. And so I think we're getting a lot of commercial real estate projects that were financed based on low rates forever. And people, basically developers and builders, overpaid for property in Miami. And
shocking, John.
Guess what?
Shocking.
Guess what? The rents are not going to cover the nut. And when they go to refinance, already you're seeing a lot of distress in the office market, generally in the US. A lot of owners have handed over the keys to office buildings, and you're going to see a lot more of that in all different sectors, because honestly, the rise in interest rates, when they have to go and refinance these projects, they're not going to make any sense. And rents are not going up nearly as much as people expected them to, even in the apartment sector, because we got a tsunami of apartments that are coming online. I think the South Florida Business Journal reported a few weeks ago, there are like 55,000 units under construction in South Florida.
John, we have 1,000 people a day moving to Florida. That 55,000 is not enough.
That's on top of the inventory that we already have. It's going to flood the market. And all these developers who were banking on rising rents forever, and now they're going to be facing flat or lower rents, and they're going to face a much higher cost of capital when they go to refinance their buildings, are going to be really in some trouble. And already you're seeing hedge funds, private equity raising a lot of money to go in and get ready to buy distressed properties because they know what's coming. And I think generally the sense on Wall Street, and Jamie Dimon is just helping to prepare people for that possibility that if interest rates go much higher, you're going to have a lot of problems. And commercial real estate is going to be one of those areas that's going to be hit hard.
And John, how about insurance as it pertains to commercial real estate? We don't even have to talk about developments, but income producing commercial real estate. One of my commercial real estate broker clients tells me that certain clients of his, commercial real estate owners, are stuck because their insurance costs have gone up as much as 300% year over year. I was at the Urban Land Institute Miami Summit last week, and Stephen Vecchito, one of the top executives, maybe the top executive at Adveneer, a prolific multifamily owner-operator, was giving a case study of one property of his where the insurance costs went up 70% year over year. And even at 70%, you can't make up that cash flow. That was his point. Combine that with the cost of capital, you can't really raise rents, and you're even seeing in some cases some rent softening. So how do you make up for that loss of income and loss of valuation? And the reality is you can't right now because the insurance industry is in such a crisis and there are so few options. So the insurance, as it pertains, there's been so much focus on, understandably, residential insurance, but commercial real estate has been at a standstill as much because of the insurance costs than the interest rates.
And the construction costs on some of these projects have gone through the roof, and all of those things combined are going to stress the market.